So I'll talk about an example that hopefully is a little bit more relatable than trading grain for gold in ancient Babylonia, and that's a brand we all know and recognize. And Nike famously got started at the University of Oregon by a track coach making shoes on a waffle iron in his office that looked kind of like this. And they realized that they were onto something, and the CEO and founder, Phil Knight, talks a lot in his memoir, Shoe Dog, about how when they started producing overseas, it was just one working capital challenge after another. It's a great book if you haven't read it. It's one of my favorites. But he talks a lot about how they went overseas and they had no track record. No one knew who they were, and they had to pay for all these shoes in advance. Because they didn't have a track record, they couldn't go to a bank and get financing. There's a really famous story where the company almost goes under because they have a $25 million bill to pay to U.S. Customs. And they're stuck because they've got the shoes sitting there with CBP just waiting to be cleared, and they've got a customer ready to pay them, but they can't clear them and get them to that customer until it's cleared. And so they're stuck scrambling time after time to find someone to bail them out and get the goods cleared and to their customers. Now, obviously, Nike flourished and figured out how to solve those problems at scale and became the largest apparel company on the planet. And today, the working capital challenges in their supply chain are very different, right? As a larger party in trade, if you're an enterprise business and you're working with smaller factories, you have an opportunity to ask for longer terms. You're their biggest customer, so you have a lot more negotiating leverage in the equation. The difference there is that your factory now needs to figure out if they're giving you 60, 90 days to pay or letting you pay after delivery. They need to figure out how to fund their business and keep up with the next order and the next order and the next order. And the thing about this cycle is, the faster your business is growing, you might have negotiated great terms, but it's harder and harder on your factory. And the real point of this story is that whether you're Nike back in 1972 getting started, or you're a large enterprise today working with hundreds or thousands of suppliers around the globe, in every single transaction, one party is taking on more risk than the other party, and another party is shouldering the working capital burden more so than the other party. And so when we looked at the market and we recognized that this catch-22 is really central to just how countries trade with one another, we looked at letters of credit. We didn't think that they quite solved the problem. We looked at solutions out there like factoring and asset-based loans. And if you're familiar with those, it's basically borrowing with your inventory as collateral. And the challenge there, again, thinking about the Nike example, is if you can't borrow against your inventory until it's past U.S. Customs and in your warehouse, then it doesn't really solve the problem at the time you need it solved most. So we've heard from customers, as we talk to customers, a large part of how we develop products is we ask you, what's keeping you up at night? What are your biggest problems? How can Flexport make your lives easier? And this theme of, because of the dilemma that we just talked about, this theme of not having quite enough cash to run your supply chain optimally is something that's come up over and over again since we started Flexport. I personally had hundreds of conversations when we were trying to figure out how to build this product, and there are a couple themes that emerged from that we heard directly from our customers. The first is that not having enough working capital doesn't allow you to be in control of your supply chain as much as you'd like, right? You can't be as flexible. You might be forced, if products are running out of stock, to pay for that last-minute air freight. Otherwise, you're going to disappoint your customers. And you can't try necessarily new routing options or new transportation partners because you've just got to get it as fast as possible, and that's the only thing that you care about. Another theme that we've talked a lot about, especially in the last year with global trade environments, is the inability to diversify your supply chain. Right? If you've been working with one factory for the entire life of your business and you've been able to gradually get better terms over time, the investment required to move to a new factory, say move out of China right now, for example, or make other changes and just diversify risk, is a huge burden. Right? It requires a lot of upfront investment in starting those relationships. And as a result, what we've seen is that businesses tie up a lot more of their cash, whether they're a high-growth, venture-backed business that needs to tie up their venture capital in their supply chain or just reinvest too much of their profits in actually buying more inventory. The real downside of that is you don't have the ability to innovate. Right? You can't invest as much in R&D and programs that are actually going to grow your business if every spare dollar you have is tied up in the inventory that's sitting in containers on a boat just waiting to get to the States. So with these challenges in mind, we created Flexport Capital, and our our mission is to help every business access the capital they need to trade. And we started through customer development with all of you, right? We started with a suite of products specifically for U.S. importers. There was a lot that we saw in the market that was great for businesses once their goods were landed and they had a lot of assets. There's a fair amount of solutions for exporters, but there wasn't anything really designed for importers. And so we built this product really with your feedback, and we think it solves some of the challenges in ways that nothing else on the market does. We're trying to give that same ethos that we've built our freight forwarding platform to our trade finance products. So the first thing is, anyone on your team that's booking a shipment, once you're approved for the program, we can, with just a couple clicks, access the financing and get your suppliers paid. Again, they're already hopefully using the platform and uploading CIs, and we've got their payment information, so we can automate that part of the process. The second element of the service is the same way our clients tell us that they love the visibility that we provide into their supply chains. We can show you where your containers are anywhere in the world. We want to provide CFOs the ability to understand exactly what's outstanding at any point in the time and tools to forecast exactly when they'll get more availability back so that you can plan. If you know that you've got a couple shipments that you need to pay for in October and November, you can plan your next orders and know exactly when that availability comes back to redraw and finance the next shipments. Of course, this also integrates with the analytics. So if anyone, a lot of the folks I work with on finance teams really love things like the landed cost calculation that we provide in our analytics. We fully integrate with that part of the product so that you can see exactly what the impact is, and you can make better decisions and choices around when you want to finance certain products, what trade lanes you want to finance, if you want to get really granular and make decisions there, if you want to understand the impact on your margins and profitability from any shipment on a SKU level basis. You get the same visibility that we provide on the freight side now with this financing fully integrated. We really want to empower teams to make better decisions, and that starts with providing you all the same data that we have access to. I think one of the best pieces of feedback that I've heard from our customers is that with some additional working capital, that incremental money that we provide, it allows you to take control of your supply chain again. It allows you to plan more strategically, make decisions like taking the slow boat through the Panama Canal and saving on your transportation cost, which can make a shipment significantly more profitable than it would be if you had to go with the faster option because you couldn't tie up cash for that long. On the flip side, if you do have a product that you really want to get in the hands of your customers quickly, you can choose that expensive or you can choose the faster transit options in the air freight and know that you don't need to pay for it up front, but you can actually make the sale until you need to pay us back. So that flexibility is one thing that we've seen drive much better collaboration between our operations teams and the finance teams at our customers. The second thing and benefit that I want to highlight is that it's one less task for our customers to do. A big theme of what we're trying to build is automation and make our customers' lives easier. And so we handle all the payments on your behalf when you participate in these programs. So not only is it one less hour of your day spent reconciling with AP that we can free up for more strategic activities, but we also are, we think, able to provide a very high level of service that minimizes disruptions. We've seen clients that routinely had, say, a shipment delayed because their supplier didn't release the telex, because they were waiting for someone to send them a screenshot of a wire confirmation. All of that happens naturally in our platform and our service so that we can prevent any delays from impacting your business, and you can focus on the more important activities. And lastly, as we talked about earlier, with the time and cash that we can free up that's currently trapped in your supply chain, the best benefit that we bring to our customers is that they can invest that elsewhere. You can invest in bringing new products to market by doubling down in R&D or doubling down on that next marketing campaign to actually acquire more customers and drive growth. It's often a zero-sum game until you get new liquidity in the business, and that's really how we provide something more beneficial than just another working capital solution. It's freeing up working capital from a place that it really shouldn't be tied up today. One of the customers that we've done this with is a company by the name of Vitruvi. Vitruvi makes these really beautiful ceramic aroma diffusers. And they have been around for 5 years now. When we started working with them, it was a year ago in the summer of 2018. And I met the founders, and they had a great business. Their products were selling out. They were getting picked up by a couple new stores, and things looked really great on the surface. but they were stressed out because they had a couple of fundamental issues keeping them up at night. The first was they kept running out of stock. So obviously they were feeling bad that they were disappointing customers and not able to grow as much as they'd like. The reason they were running out of stock is because they had a great supplier who was able to meet the quality they needed, but they only had one supplier, and they'd been working with that supplier for years, building up a lot of trust, but they were starting to meet the limits of what that factory could produce. And so every time that factory produced an order, they would air freight every single unit over to the States so that they could sell it as quickly as possible. As a result, they saw their margins get depressed, and they were struggling to remain profitable. So when we started working with them, we immediately saw the potential. Here was a product that was selling like crazy, and we were in a really unique position to solve their problems. So in a couple weeks, we got them approved for a line of credit. The first thing that they did was diversify their supplier base. They found another factory who wasn't willing to give them great terms at first, but now they could afford to work with them and make that investment because of this additional capital that they had. So they diversified their supplier base. Then they were able to immediately get their products, not immediately, but in a couple weeks, get their products back in stock. And once they were at the stock levels that they wanted to be at, they could take a more strategic look at their transportation options. At that point in time, they were able to figure out that if they ordered a little bit further in advance, they could move their entire supply chain from air to ocean. That saved them, they were previously paying over $10 a unit in transportation costs. By moving to ocean, they were able to get that below $1 per unit. So essentially, the business became profitable overnight while accelerating their growth with the products that they were able to keep in stock and the decrease in landed costs, despite bringing in a new financing partner.